Hello, hello, hello. Nick again with another installment. And this one, I'm excited. It's my favorite. It's about credit spreads. Credit put spreads, to be exact. I'm not going to talk about the call side because we're happy people here. We just want to be bullish stocks or tickers. Okay, so this video segment will have the assumption that you've already seen the other ones. In other words, you would have to know you've seen what is a put, what is an options, what is a spread. These are all separate videos. And the call side as well would help, not necessary, but it would help. It just adds to your knowledge. Again, you'd have watch the video about options and the one about spreads. And then we will talk about the credit spreads here today. So I won't revisit all the nuances that are there because I want to assume that you've seen them and understand them. Okay. So a reminder that when I take a position, I do homework and I share it. I do a video, I share a table with all the data, I share a write-up in plain simple English, and I usually tell you how I got to this. So there's the macro, what the world looks like. There's the micro. Within that world, let's say there's no problem within the world, macroeconomic conditions. How does this particular stock, in this case, this is not a recommendation for this particular stock. This is just a scenario to illustrate the point. And what's the company look like? And then, most importantly, the thesis. Why the heck am I taking this trade? That is like the most important thing, because I get questions like, hey, what should I do about this trade? My immediate question is, why did you open the trade? They take offense to it. Like, what do you mean? What do I mean? What do I mean? What got you into this position, and is it still there? If it's not there, then you shouldn't be in the trade anymore, right? So that's part of the stop loss video. Not necessary for this purpose. Okay, but it's good to go see. So how do I approach this? So in the definition of puts in prior videos, I spoke about, let's say I want to own the stock, forget what the stock is, and it's currently at 640, 645. I want to own it, but I want to own it lower, and I want to reserve my price. Then I would sell this put. I picked it randomly at 560. So that gives me a nice buffer from here to here, 645 to 560, whatever the stock is. Again, this is not a recommendation to trade this particular scenario. This is an illustrative scenario, and hopefully you watch it after time has run out. Then you can't do that. So this would be a bullish position because A, I want to buy the stock, and B, if I don't want to buy the stock, I want price to be above it. To stay above it, and that's how it dies. And I collected $1,000 per contract, and if nothing happens, $1,000 is mine. I didn't buy the stock, and I kept the $1,000. So who lost? The person that bought the put from me. Maybe somebody needed protection. Maybe somebody thought that Tesla would fall. They were wrong. I won. Okay. But that is a lot of responsibility. In fact, this is a practice account that doesn't have a lot of money into it. Now, I'm going to show you how much risk there is in it. Watch this. One contract. Remember, one contract is 100 shares. I want to sell it. Watch this. Nope. I don't have enough money in this account. So it takes a lot of credit in order to sell a naked put, especially in a stock with a ticker price of 560. Notice I didn't say expensive. Regardless, it's a high ticket price. Requires you need to be able to spend 100 times $560. That's a big pile of money. So how can I limit that and still do the same thing? So what I do is I would sell a put spread. It involves selling the same put and buying a put below it. Notice, selling the same put and buying a put below it. So what's different? So in the other scenario, I collected $10 per contract, $10.40. In this new scenario, I'm going to collect $10.40, but I'm going to give back $8.85. So the net effect is $1.60. I'm going to round up, $1.60. And what does that mean? That's my maximum gain. But look, watch this. I go to open the trade. It goes through because it's limited loss. Now the machine knows I can only lose X. Okay, so still a credit. It's still a bullish position because it wins by price not falling into it. not getting to it. It can fall into it, but it shouldn't get into it. And I receive $160 to open the trade. Sweet. Okay, so what's the downside? That's all I can make. Okay, it's still not a big deal. It's a good chunk of money. What's the upside of doing the trade? I gave up a lot of money to do that. What's the upside? The upside is if it goes to zero, I know how much I can lose. And this is where the rub comes in. This is where somebody that barely knows options, that wants to make fun of you if you're selling put spreads. Let me tell you what happens. I guarantee you that will happen. If not, you're thinking it already yourself. So let me walk you through the English of this trade, the metrics, and you're going to laugh and say, oh my God, you're crazy. So I am risking $8.40 to make $1.60. Whoa, that sounds crazy, man. Not so. Let me rephrase it. So usually when you buy a stock, you hope for a rally. You don't have any certainty of said rally unless you have inside information. You can do homework to try to skew the odds in your favor, but it's still pretty close to 50-50 shot, right? It can go up, it can go down, it can linger. In this case, I have a measured 83 to 85% certainty, theoretical chance of success. And what is success? Success is a yield of 19%. What? Yeah, 19%. $1.60 over $8.40 is 19%. So I have an 85% chance of yielding 19% in 23 days. Now, I don't know about you, but yes, I've seen stocks move 20% in 2 minutes these days, especially if they're a SPAC about EVs. But you can't forecast it with any certainty. It's just wishful thinking, and you buy, and everything goes up. In this case, I'm not buying anything. There's no money coming out of pocket. I'm collecting money and waiting, tick, 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 time ticking by, and I make money. How do I lose money? If price falls from here to here and into it below 568, then I start losing money. I've got $1.60 in buffer. So it can fall below 560 by $1.60. And that would be my break-even point. So I don't know about you, but I'm a calculated risk kind of guy. To take this concept to another extreme. So this one has an 85% theoretical chance of success, correct? It risks a lot of money. I like to risk more money with higher odds of success versus somebody who's the type of gambler that has more. It's not a bad label. It's just somebody who's more likes to take bigger risks. I am a boring guy. I want base hits. I'm not swinging for the fences. 19% is plenty fat for me. Somebody might want to swing for 400% on every trade. That's not me. So I'm a race car driver. In the olden days when I used to race, I preferred placing top 5 in every race to win the championship versus going for broke on every lap and winning a couple of races and crashing the rest. I guarantee you the person that places top wins the championship. Think like in the olden days, if you're old enough, Bobby Rahal. Never a star, 3-time champion because he placed podium like almost every race. So steady wins the race. It's a long game. If that's my preference. So how can somebody make it more exciting and less risky dollar-wise, more risky event-wise? So let me show you. I'm moving it up, right? Remember how I collected the $1.60 in the other one? Okay, so this one collects $3.20, and so why wouldn't I want to do that? Because my odds of success have dropped under 70%. So you're saying that's pretty dang high. 67%, 65%, that's pretty high. Is it? What's a coin flip? 50. 65% is pretty close to a coin flip in my book. This is not an exact science. It's like a boat on water. So, yes, 65%, 68% sounds pretty high. But it's too close to a coin flip. I lose a lot of edge. Yes, I still have a buffer, but this is a fast-moving stock, and it's got 23 days to do it. This can get in trouble really quickly. How does it get in trouble? Price falls to it. That's in trouble. There's no way a trade that yields, how much is the yield up here? It's 47%. There's no way a trade yields 47% is going to be easy. I guarantee you that. They weren't born yesterday, they being the market makers. They're never going to let you win easy 47%. They're going to make you work and sweat for it, maybe change underpants a couple of times. So, not my jam. I like to take less, get down here with a higher certainty, and still deliver 19% or 15% or 12%. Sometimes it's 25%. Those are more boring, higher odds. So here, what's the advantage? I'm risking a lot less. In the other one, the one lower, I risked $8.40 because I only collected $1.60. See, 10 is the width. In this case, I'm collecting $3.20. So the maximum is dropped below 7, $6.80. See, now I could lose less money. So it's less risky from that perspective, but it's more risky because now the event, the chances of success has gone through the roof compared to the one down there. So I personally prefer these guys over these guys. See, this one right here puts a lot less money at risk, but it's a 50-50 shot. Not my jam. Okay? So if you want to gamble and say, or let me rephrase, I don't want to insult anybody. If you think Tesla is definitely going to be higher in 23 days, definitely, this is the one I'd sell. Because I'm collecting 250, I can lose 250, coin flip. So now if I sell 10 contracts, I'm going to collect $2,500. And if Tesla is at $646 or $645 and a penny in 23 days, I made $2,500. What can I lose? $2,500. Why is it like that? Because it's a coin flip. I don't know what it's going to be. It could be 643. It could be 647. It could be 660. It could be 500. I don't know. So, but if it drops a little bit, I'm in trouble immediately. If it doesn't rally, I'm okay. If it rallies a little bit, I'm okay. So that's why they pay you a lot, because you have to work for it. And it's very iffy. Versus going down lower, they pay you less, you risk more dollars, but you get something for it, somewhat of a peace of mind. Okay, so this is the concept of doing spreads. First of all, instead of naked puts, that limits. When I do a spread, I sell a spread, I limit the out-of-pocket expense. And I like selling a spread because I take the risk after doing my homework and I'm confident with my positions. And a lot of these work out. Very few blow up, and when they do, there's something out of the blue that shows up that you can't plan for. And you know what? It happens, as they say, poop happens. But odds are they shouldn't, given the statistical models that they have in there. I didn't make these these statistical numbers, that they give it to me, so I just use it. So it is they're not foolproof, but they are designed to be boring. So a credit put spread is a bull put spread where I collect money up front and I need time to tick and nothing happens. So a few caveats about that. I don't do a ton of these at the same time. I don't do a ton of these of the same kind. Like I don't do Facebook, Apple, Google, all at the same time, because one bad day in the quote FANG and MAGA, whatever they call them, then all of them go sour and the portfolio suddenly is red, right? So I might see red throughout, but if price stays above, it doesn't matter. Nuances about the spreads is what I do with them if they do get in trouble. So some people put a stop loss at X%. So I like to start thinking defense when the odds of success get to 70% or lower. Then it starts to be close to that coin flip I was talking about. It's like, you know what? When I took the trade, things have changed. Let me book it. Let me move it. Let me defend it somehow. So other times I say, nope, let them take it. Let it fall into my spread. I'll take the stock and I'll sell the put. What does that mean? So if I had sold a put spread down here, like the one we were talking about, this one, and price fell to that, and now this $1.57 turned into $4. Like, oh my gosh, I'm losing, $3.40. I'll say, you know what? I'm not going to defend it. I'll take the shares. Then I'll sell this leg for a pile of cash, and I'll promise to buy the shares. And now my break-even point is lower, way lower. So this is one way of defending by not defending. But I only do that when I want to buy the shares. Or I can close it and open it somewhere else. They call that rolling. It's really closing one losing position and opening it somewhere else because if I need time. If the trade setup is broken, I should just close it and take the loss. You win some, you lose some. When do I do that? Some people close it when it gets halfway through. Some people close it when it gets 1/3. Some people don't close it until it gets to the door. Personal preference, personal preference. Balance in the portfolio is always an important part of it. All right, so this is enough talking here. Can't tell you everything about it in one video. I want to, but I just can't. It's already 15 minutes long. Know that it's a calculated risk and nothing is free. So the more boring it is, if it still makes sense from a yield perspective, I do it. Otherwise, I pass. Few rules about it. I don't do it on an up day. So if the stock is moving 10% up in one day or 5 or 3% up in one day, that's not a good day to sell a put spread in my book. I would chase with debit calls or debit call spreads. I don't like to do a credit put spread on a good day for stocks. What's a bad day is when a good stock takes a tumble for whatever reason, like CRM. Took a tumble when it decided to buy Slack. Like the stock fell 25% in a few days. It's like, you know what? Now it's a good time to get long it when everybody else is fleeing from it. Another perfect example is during the COVID crisis in March, AMD was falling out of bed. I sold puts and put spreads at 20 and 18 and made money out of thin air. It didn't even come close to it, but somebody panicked. Somebody bought puts at 20. 20. It was still in the 50s. Anyway, 40s. Nick signing out.